person industry. I forget them sometimes. So a generalised presentation in the second half, but first I want to cover something I'm pretty proud of, and that's Newcrest. I joined Newcrest 5 years ago, and I joined it from Rio Tinto in London, so I was an executive with Rio in their London office. I looked after global technical excellence and projects and maintenance and a few other bits and pieces. It was a pretty comfortable existence. Then some people came along and said there's an opportunity for you to join Newcrest. And I looked at the assets and I looked at the profile of the company. It was one of the few Australian mining companies left that actually had the capacity to build itself into a mid-cap to largish mining company on a sustainable basis. Because if you look through our mining industry and you look through the ASX, we haven't got much of a mining industry left. So even though we've got lots of entrepreneurial action, a lot of the mid-cap area of the stock exchange has disappeared. That's pretty sad for a country that really exists on the back of the miners. Our standard of living is set by what mining does and what mining is allowed to do. So that was the reason I came to Newcrest, and I'm extremely proud of what we've done as a team over the last 5 years since I've been at Newcrest. So I'll just give you some snippets about what we're about. And I'll hark back to that first speaker today when he talked about innovation and whatever. And as I go through some of our projects, I'll bring some of those points out. So we're the third largest by market cap in gold, 12th largest on the ASX, around $30 billion. And most importantly, we have the ability to mine anything we find. So we've got skills in narrow vein mining, high-grade epithermals, through to very large open cuts, and sublevel cave and block cave. So there are very few mining companies left in the world that actually have the skill sets to mine anything they find. That's another thing to ponder on. The de-skilling of the whole industry really does place a pressure point on the future. So this is what we look like. We've got Bonikro in Côte d'Ivoire. And I've been told there's no use doing this because you can't see it, but that's over on the left-hand side. We just got over a bit of a hiccup. We did have an over-sufficiency of presidents up until quite recently, where there was an election last year and the incumbent refused to step down, and the person who was designated as the winner wanted also to be president. That's now resolved, and what we have got in Bonikro is an operating mine which we've put our management team back into and will be back in production as of June. That produces about 120,000 ounces a year. But most importantly, it sits on 17,000 square kilometres of some of the best greenstone belt in the world. Now, the percentage of the greenstone belt, which is very similar to Kalgoorlie's greenstones actually, the percentage that's owned by Côte d'Ivoire of the greenstone belt in West Africa is higher than that area that's owned by Ghana. Ghana's found over 80 million ounces in their exploration history. Côte d'Ivoire's found about 4 million ounces because basically there hasn't been much exploration. So we think there's lots and lots of upside in that for the future. Our next mine is in Gosowong in Indonesia. I'll point to it and probably won't make any difference. It's on the island of Halmahera. It's the second richest epithermal mine in the world. Its grade is somewhere between 20, 25, 26 grams a tonne. So every tonne we mine and move there is worth a few bob at the moment. And that produces around 450,000 ounces a year. We've just had permission to start off a second mining front on our contract of work. So we're actually setting up our second mining front, and the exploration teams are suggesting that there's a third and a fourth mining fronts going forward. Our next one's on Lihir Island, and I'm sure you can see that off to your right-hand side. That does about 850,000 ounces at the moment, but is in the process of being upgraded to over 1 million ounces per annum. Hidden Valley is our second operating mine in Papua New Guinea. That does just over 200,000 ounces at the moment. It's still ramping up to full capacity in excess of 250,000 ounces a year. And Wafi-Golpu and Namosi I'll come back to afterwards. And then in Queensland we have a nest of 2 mines, one open cut and one underground in Mount Rawdon and Krakow, that between them produce just over 200,000 ounces. Cadia Valley has 2 mines, an underground and surface, which between them produce this year will be around 550,000, 600,000, but that's on its way up to nearly 800,000 ounces. And then at Telfer, we have a surface and an underground mine in Western Australia, and between them they produce around 650,000, 700,000 ounces. So that profile of production for a gold miner is the highest that any Australian mining company has ever done. So for a country that's produced a fair percentage of the world's gold, you would think that in the past we would have had multiple million-ounce producers before. This is the first time someone's gone past that multiple million-ounce production point. Another thing we're very proud of and what we've been able to do over the last 5 years is a manifestation of our risk management in safety. Now, a lot of people put up frequency rates such as this, and it really doesn't mean that much. Well, it's 0.25 per million work hours. Well, in lost time accidents, that means that an average person that works for us or is engaged with us can expect to have a lost time accident once every 2,000 years. And to have an accident which includes medical treatment or above at that intensity once every 150 years. So we think we've actually achieved some fairly benchmark points in how we go about our safety, and we're applying that approach right across what we do with risk. This is our growth pipeline. The top 3 grey bars are what we've just been commissioning over the last 12 months. The next 2, the yellow bars, Lihir Expansion and Cadia East Mine, are the current projects that we're undertaking. So Cadia East will be ramping up during calendar year 2012, and Lihir ramping up, the expansion of Lihir ramping up in calendar year 2013. At Lihir, we should be able to take that to in excess of 1 million ounces of production per annum for at least 20, 25 years. And it's got at least a 40-year production front in front of it at the moment. Cadia East will take up to between 700,000 and 800,000 ounces per annum, and between 75 and in excess of 100,000 tonnes of copper. Now, the speaker this morning talked about new technologies and new approaches to mining and whatever. We've been in a technical association with Codelco in Chile for the last 3 years. And between them and us, we've developed what we think is the next step of refinement in panel caving or block caving. So basically what that means for Cadia East is we'll be able to mine an ore body underground, 1,500 metres deep at its deepest point, at a similar cost structure to an open cut running with a strip ratio of 2:1. So basically we can mine underground mines with the same cost structure as open cuts. So the total costs at Cadia Valley, once we get Cadia East up and running, will be less than $20 a tonne. So that's mining costs, processing costs, admin overheads, every cost on the site, less than $20 a tonne. And if you take copper at $2 as a byproduct credit, then we'll be producing gold at less than $100 Australian per ounce cash cost. And we should be able to do that for about 50 years. We think there is an extension of Cadia East down further, so we're looking at bringing that on as well. Both of those projects are being carried out of our cash flow. So we have a profile of cash flow now that we can bring in a $2 billion project in Cadia East and a $1.3 billion project in Lihir and carry those out of our cash flow, as well as 6 or 7 other advanced projects that we carry within our study teams. So the next 3 grey bars are smaller opportunities that we're pursuing as studies, and then we get on to Wafi-Golpu and Namosi. Now Wafi-Golpu is making itself into a sort of a look-alike of Cadia Valley, but its grades are far better. So we've just lifted the exploration target at Wafi-Golpu to 40 million ounces of gold and 15 million tonnes of copper at an average grade of 1 gram per tonne and 1% copper. But we haven't actually hit the sweetest spot in the porphyry system yet. The last hole we drilled was over 800 metres at 2 grams and 2% copper, which included over 600 metres at 3 grams and 3% copper. And as we've been drilling these holes to the north, the ore body's been expanding and the grade's been going up. So that'll give us a mine that'll produce at least 1 million ounces a year and 300,000 to 400,000 tonnes of copper. And we hope to start production there around 2014. And then the next big study, which should manifest itself over time into a mine, will be Namosi, where we've already identified 1.6 billion tonnes of fairly low-grade gold and copper. But the drilling we're doing around other orbital ore bodies is suggesting that there's higher-grade starter pit locations. So that just gives you a bit of a background of our growth, which manifests itself in this graph. So by 2014, we'll be up at 3.75 million ounces of gold. And in August of this year, we're going to refresh this graph and take it out to 2016. And those out years past this should start with a 4. So we continue to grow the profile. And over time, we'll be bringing in more and more copper to go with that gold. So a very low cost production profile. Growth in gold reserves from December 2006 to December 2010, we've stuck to our knitting in the amount of money that we put into exploration each year. And you can see the results of that up on the screen. We've been able to increase our reserves by 133%. Compared to the other gold majors around the world. And we put about 150, 170 million into exploration each year. We're pretty proud, and we track this as a KPI, that over 50% of that amount of money goes into drilling. Now, a lot of mining companies these days put a lot of money into exploration and they fiddle fart around and they don't actually go and test their models of their ore bodies intensely enough. We track that as a KPI and all the geos get a bonus based on the percentage that goes into drilling, or what we call the truth serum. The other interesting thing about this number is that we use the lowest gold price to get an ounce into our reserve base. So in the upcoming year, we'll use $850 US to get an ounce into our reserve base. Most of those other majors are using in excess of 900. So we're the most conservative, but we find more gold at lower cost than anyone else in the industry. And a lot of that's about innovation. What we can do in Papua New Guinea, other people are coming to us now and asking us how we can drill such deep holes. We don't tell them, of course. Efficient use of capital. Last year we were at 38% return on capital employed compared to the other majors in the gold industry. And we've been the front runner in that over the last 3 or 4 years. So the way that we bring on our projects and what that means as a return really keeps generating that cash flow so we can bring on more projects. 5-year relative market cap. In 2006, Newcrest was the light blue and the green bars. Oh, sorry, the light blue bar. And the rest of the gold majors were the dark blue bar. In 2011, Newcrest the green, and then the rest are red. So you've seen we've come from a position where we were fairly small within the industry as a global major to a position where we are third biggest with market cap. And it's grown, that market capitalisation's grown over 6 times the 2006 size in under 5 years. So if you're a shareholder and you invested in us 1 year ago, your total shareholder return over that year would be in excess of 20%. If you invested 3 years ago, your return would have been over 40%, and if you invested 5 years ago, your return would be over 100%. And we keep that as a clear driver. You hear a lot of mining companies don't actually talk about what they're doing for their shareholders, what they're doing with their capital. They are two determinants of your future capacity to grow and for people to give you money when you really need it. So we think we've built something that's quite unique. This is an Australian mining company, third biggest in the goldfield around the world, with the capacity to continue to grow. We've got one of the lowest cost structures in the whole of the industry, and the application of our technology through mining methods and what we're doing in our process plants, because we're developing new ways of separating and first order beneficiation, will continue to keep us at the front of the pack. So we can continue to employ mining engineers, etc., out of Australia and have a point of view which really centres around the Australian ethos of how you go about business. So that's the end of the advertising. I'll get on to generics now for the industry. I'm going to cover economic impact of the resources and the energy industry, and then I'll cover employment. And they're 2 information points, if you like. And then the last 2 points, education and training and carbon tax, really talk to the 2 main pressure points that the industry is facing and what we are and not doing as a nation and how we're about to blow our feet off. Okay, top Australian commodity exports. There's the top 10 for this year. You notice 8 of them are out of minerals and energy. We are the quarry of Asia. Our standard of living in Australia is set by these industries. People can sugarcoat that as much as they like and talk about diversification, but this country at the moment and for the foreseeable future will have its standard of living set by the pricing and the structure of the minerals and energy industry. If you look at it on a balance of payments basis, over 50% of our exports come from those industries, minerals and energy. And that will continue to grow quite remarkably over the next few years. 10 years ago, only 5% of our mineral exports went to China. It's now 37%. 10 years ago, just over 50% of our exports in minerals went to Asia. Now it's in excess of 75%. I'll come back to my comment before. We are Asia's quarry. We are linked at the hip with what China and Vietnam, etc., are doing. And any interruption to that flow will have long-term implications for Australia. We're also the entrepreneurial hub of the ASX. So there's 600 metals and mining companies listed on the ASX. 400 juniors have floated in the past 5 years. In the 90s and early 2000s, we constituted 10% of the market capitalisation of the ASX. We've now increased that to 23%. So we're second most important sector behind the finance industry at 32%. And this is what the investment profile looks like over the last 10 years. So this compares the ASX 300 with the ASX Metals and Mining 300. The gold bar is the metals and mining investment profile over that 10 years. And then if you'd put your money into the black bar, which is the normal ASX 300. So comparatively speaking, over the last fortnight, it's been giving better returns than other sectors of the ASX as well. So moving on to employment, this is the 10-year employment growth by sector. You'll notice one interesting thing. Mining has been soaking up the spin-offs of employment falling out of our agriculture and manufacturing sectors. So the other, which is service industries, have been growing slowly, but that growth in mining has actually maintained or allowed us to get to a point where unemployment is 5% or less in Australia. And with the upcoming profile of demand coming out of 72 advanced projects, that will continue going forward. There is a great demand for employment in mining, and that $133 billion that we're about to spend on new projects will propel that and maintain it. So the sector employs directly just over 205,000 people, indirectly 600,000. And by 2015, if you look at the persons that are going to be generated as being needed out of those projects, plus the people who are going to retire and whatever, we're going to need another 77,500. So basically that direct employment will have to grow quite markedly over the next 4 or 5 years. I don't think Australia's infrastructural training facilities are really there to provide that type of backup to the industry. So let's move on to the two contentious points and where the pressure point comes in for Australia and what we see as our industry: education and training and the carbon tax. This is what we pay a graduate. So the minerals industry pays more than any other industry for its graduates. You'd think that that would be a basis of great attraction for a lot of persons who are going into uni and through uni and whatever. We'll compare that to this. Even though we pay more, and the average mining engineer in Australia is now on more money than the average GP, we're going to be short 1,700 mining engineers over the next 5 years. So why is it that people aren't attracted to our industry? I think that about 30 years ago, we forgot that we've got to advertise, we've got to make sure that we tell our stories within the greatest breadth point of society. So for a long period there, a lot of our younger and brighter persons did not want to join the industry because it really wasn't politically correct. We now find ourselves in a situation where even though we pay well above the average for all types of employment compared to other industries, in the professional ranks we still we cannot attract the right people at the right numbers to maintain the industry. Some of those projects I talked about before, their productivity, their efficiency, their effectiveness will be downgraded because they won't be able to attract enough of the right people. Let's move on to apprenticeships. We peaked at over 175,000 apprentices in 1989. Current numbers somewhere around 120,000. So we'll have a shortfall, this is an expected shortfall, that by 2015 we'll need 36,000 more tradespersons than is in the pipeline to be trained at the moment. Again, that talks straight back to those projects. We're going to be investing $133 billion in projects and we won't have people to staff them properly. So this is how many persons in 2009 were being trained in apprentices and traineeships within the mining industry. You'll notice it's doubled since 2005 to just under 10,000. But if we really want to meet the demand that is coming from those projects, we really need to at least double that again. The government in the latest budget papers, etc., flagged that they're finally going to have true movement in facilitating some of the increased training for apprentices, etc. But I think industry needs to be moving far quicker in that direction as well. We just will not have enough tradespersons in Australia. And the sad thing is this, that even though that great demand and those great potential income streams are there, so every tradesperson should be able to get a job, we still have a situation that across the whole of Australia, 45% of apprentices that start pull out before they finish their apprenticeship. And that wasn't even addressed or spoken about in the budget papers. So what is the fundamental structural reason that apprentices don't stick with it? Well, in some ways we're our own worst enemy. A lot of our apprentices really want the big money earlier, and we haven't got the structures to go with that to facilitate a different way of making sure that apprentices finish. And then the last point is with the baby boomers starting to retire, etc., up to 85% of the available workers over the upcoming years will be 45 years or over. So we haven't done that good a job with our apprenticeships and trainee systems in Australia. How are we going to retrain a lot of those older persons who are 45 or older to take up those positions that those projects are going to generate? So we're heading for a situation where the productivity of projects and the productivity of the area will be impacted because of our lack of training profile. You know, since 2004, the productivity of the mining industry has nearly halved if you take a traditional measurement on an efficiency basis. Because prices have been good, people have wanted to bring their projects in at whatever cost. Now that's had a productivity impact of a negative, and then on top of that, with the next wave of projects coming on, we won't have the trained persons to bring them in with the right productivity either. So as a nation, we'll continue to build a productivity shortfall, which, if we do have a reversal of prices in our commodities, will really lead us to a very deep recession in Australia. So let's move on to my favourite topic of irrationality, the carbon tax. A lot of pollies and others toddled off to Copenhagen and made promises. If you take those offers or promises and apply them in economic impact in 2020, what Australia promised would have the biggest negative impact on GDP. Don't believe politicians who tell you we're not doing enough, whatever. And this is at the 5% rate. We have pledged ourselves into a position that no other country has pledged itself into. In China and their Copenhagen pursuit, they offered to raise their emissions by 496% by 2020 and 1990 levels. India offered to raise their emissions by 350%, and we offered to decrease ours by 4%. Now, what we get told in Australia is nothing like that. We need to do more, we need to go further. The most interesting point on this slide is given at the bottom. The International Energy Agency last year came out and said that non-OECD countries account for all projected growth in world emissions to 2035. So the OECD countries, to make up for that, if we do really want to get back to somewhere similar to 1990 or 2000 or whatever year you pick levels of emission, have to really destroy their economies to make up for what India and China especially are going to be doing. And I'm not begrudging India and China their chance for economic sunlit uplands, but there's got to be some rationality in this debate. And action around the world has stalled. You know, the United States at national level, cap and trade schemes have been rejected for the fourth time. Their regional schemes across their states are struggling. Canada said, why should we do anything until the US does anything? Japan, their emissions trading scheme is delayed till 2013, and post what had happened to them, it may well be delayed again. And then even in the European Union, which is held up for us to look at from time to time, the amount of permits to cover trade-exposed industries is going to be the biggest ever when they start to introduce phase 3 of their ETS in 2013. So no one else is hell-bent on destroying their industry to the extent that our politicians are in Australia. The model they're talking about introducing is fixed priced for 3 to 5 years, starting at $20 to $25, and then we get an annual escalator of 4% plus CPI or thereabouts. After that, you'll have a floating carbon price. So people talk about this scheme needing to be introduced so people have surety and they can make business decisions. Under what has been proposed, the earliest anyone will have surety of what's going on is 2014, and the latest will be 2016. So the very reason for pushing this on industry that they need surety is actually completely wrong. So if you're in the power generation business, you won't have clarity of where carbon's going for another 3 to 5 years before you can make a rational decision about how you invest shareholders' money. That means we'll probably run out of power in Australia as well, because the economy will continue to grow in spite of the politicians. The other key features of what we're doing is that there will be generous household and motorist compensation, but not for those nasty polluters, as we keep getting described as. There's an arbitrary approach to trade exposure, which I'll go through in a minute. There's minimal compensation in electricity generation, so there won't be investment there. Agriculture's been excluded, which totally amazes me, because it was a great opportunity for the farmers to actually have a different approach and get rewarded for it, or those people who are already pursuing that different approach can be rewarded for it. And it's basically just a rehash of the old CPRS scheme. So under CPRS, households and motorists are slated to receive $75 billion in compensation up to 2020. The power sector and small business and industry will receive $38 billion. So this is a revenue dependency model. This is a tax grab. So basically they're going to take a whole lot of money off everyone and then pick the winners of who they compensate on the way through. European Union's ETS has raised $2.9 billion in tax revenue since 2005. Our scheme will raise that same amount of money in its first 3 months. The EU ETS per capita tax is 96 cents per annum. In its first year, the Australian scheme per capita tax will be $523. By 2020, the Australian scheme is projected to raise $150 billion in current dollars. As I said before, this is the biggest tax grab you've ever seen. Now let's get on to how you actually protect your industries. In Europe, they recognise that if you're trade exposed, you need some protection. So the coverage of the industry sectors that are classified as trade exposed in Europe, they cover 164 sectors across their economy. In Australia, we've actually come up with 33 activities to cover. I'll explain the difference. In the gold industry, if you take the average mine from where you dig it out of the ground to where you send off the gold bars or whatever, we are right on the edge of being compensated under the old CPRS scheme. So what's been done is they've said, okay, no, you've got to break those up into activities. So gold mining actually stops where you drop the dirt on the run-of-mine pad, and the processing afterwards is a completely separate activity. And because they've separated those activities, oh dear, you don't qualify for compensation. And they've done that right across all the sectors in Australia. So whereas the Europeans recognise that they have to protect a fair slab of their economies, Australia is exposing most of our sectors to no trade exposure redemption at all. The percentage of exports covered by trade competitiveness provisions in the EU is 73%, in Australia 16 to 19%. The coverage of manufacturing employment, 42 to 52% of people employed in manufacturing will have some form of provision and coverage in the EU. In Australia it'll be 8%. So you can imagine if commodities are strong, the Aussie dollar is strong, what is going to happen to our manufacturing industry? It'll disappear in the first year or so of this scheme. And the share of GDP of those industries that are compensated is 8% in the EU and only 2% in Australia. So basically this will gut us. As a country, we will be the quarry of choice for Asia. We might have a few cows running around that occasionally will bring in a few dollars. And apart from that, we'll be able to sell coffees to each other. But there won't be much else going on in Australia. So a firm's trade exposure must be a primary factor when assessing eligibility for transitional support. This approach is already used in the European Union. And I stress this point. If, and I'm not going to get into the science of debate of whether there's climate change or whatever, I'll leave that up to Mr. Plummer, Professor Plummer. But if you're going to have an international problem that's designated as an international problem, which is climate change, then we should have an international solution. So if we're going to have anything foisted on us, the mining industry in Australia will be quite happy if we got exactly the same system as what Europe is being exposed to. But the system in Australia goes to a far greater degree than anything the Europeans are going to have to face. And that will destroy our trade-exposed industries. So you've got to recognise that competing firms operating in competitive global markets cannot pass on their additional costs. Under this scheme, because we're polluters, then we're going to be penalised. And it's amazing. I said to my wife, I don't actually feel like a polluter. I don't feel as though I wake up in the morning and all I want to do is pollute. Sometimes I really want to get out there and create jobs and do other things for the economy. But if you follow the debate in public in Australia, then industry is being classified as polluters and not worthy of compensation. In other words, we don't want industry. Now, I'm not particularly worried about it for myself, but I'm very worried about it for our children and especially worried about it for our grandchildren. Because what we're doing in Australia is trying to put in place a generational change point which our grandchildren will have to live with. Whether climate change comes about or not, I would prefer them to face it having a job than being unemployed. So with that note, I'll say thank you for your time. Thank you.
Well, thanks, Ian. Thanks for that great speech there. And we'll move on without further ado on to Chris Strown on Adelaide Resources. Chris, thanks.
Fabulous, Ian. It's a pity that perhaps some of the government weren't here to hear some of those things, although I guess they already know them, they just choose to ignore them. I'm from Adelaide Resources. I'm actually going to talk to you today about a spin-out that Adelaide Resources is doing on behalf of its shareholders. We think that they will benefit if we split the company into two. And so let's get straight into it because I've got too many slides. It'll work. What's going on? What's this? Sorry, it's
Pointing it out.
that one there.
You've got to point it to the back, I think.
At the back.
Yeah.
Can you give the talk for me as well, please? Right, get past that. Okay, if you remember nothing, or only a couple of things from this talk, remember these. Peninsula Resources has a flagship project on the Yorke Peninsula, which is a South Australian exploration hotspot. And we have made pre-listing a copper gold discovery at a prospect called Willamulka. We also have, so we didn't interrupt the IPO process, we have assays from 50 further holes from that prospect, which will be released very shortly after we list. And we have drill-ready targets on 3 other projects. What you must do is come to our booth number 15, drop your business card in the bottle, the jar, to go into a draw, one today, one tomorrow night, to win a bottle of Wendouree Shiraz Mataro, fabulous wine, and take a prospectus, of course, and fill out the application form. Right. So what we're doing is we're taking 6 of Adelaide Resources' exploration projects, putting them into Peninsula. We seek to list Peninsula before the end of the financial year, before the end of June, raise a target of $6 million. There's a priority offer for Adelaide Resources' existing shareholders. We are also planning to do an in-specie return of capital to Adelaide Resources shareholders post-listing. After all, they're their assets, and they deserve to have them in a form that they can do with them what they wish. On listing, the company will have just over 55 million shares, very tight capital, and Adelaide will hold 30 million, but just over 24 million of those will go back to shareholders through the in-specie capital return that I mentioned. So that'll see Adelaide holding just over 10% of the company, so it's not going to have a controlling interest in Peninsula down the track. Board of Directors, Andrew Brown, who's somewhere in the audience here, is our chairman. He's also the chairman of Adelaide Resources. For those of you who don't know him, he's a guy with a tremendous amount of corporate experience, ex-broker, fund manager, financial analyst. I'll be the managing director at least for a little while, at least while we bed it down. It's the intention to have separate managing directors for Adelaide Resources and Peninsula, and shareholders deserve a managing director that gives his entire dedication of his time to one company, and that will be the case. A couple of others. Nick Harding is an accountant who worked with Normandy Newmont and Western Mining, and Mike Hatcher, a geologist who worked with North Flinders, Normandy and Newmont, and a terrific guy technically. Projects, 5 in South Australia and an application for a tenement up in the Drummond Basin in Queensland. I haven't got time to talk about these. I'm just going to talk to you about Moonta, which is the flagship. Okay, we sit in a world-class copper-gold province. That sort of orange area on the map of South Australia is called by Geoscience Australia the Olympic copper-gold province, and it contains deposits like Prominent Hill, Olympic Dam, Carrapateena, which has just been bought by Oz, our project on the Northern Yorke Peninsula, and Rex Minerals Hillside deposit just to the south of us. This is, don't know about the image, it's a magnetic image, but it shows Peninsula's tenement, or ADN, or Peninsula's tenement in red, and the Rex Minerals ground to the south. And of course everyone will know that Rex started life as about a $13 million market cap company about 3.5-4 years ago. They're now worth $400 million, and it's based on this hillside prospect that they've discovered. The area was very, very important to South Australia's economy. Copper was actually discovered here about 150 years ago in a wombat burrow. There's some photographs here of present-day mining heritage, I guess, and some historic photos and a historic photo. It produced about 1/3 tonnes of copper at a very high grade, although the ore was hand-picked, so it was sort of visually upgraded by what were called picky boys, and also obviously gold. The most recent production from the region was actually 2 small mines that were discovered by Western Mining, Puna and Will Hughes, that were mined in the early 90s and again produced at fairly handsome copper grades. The discovery that we've made is called Willamulka. Willamulka is just the name of a little railway siding on a railway that runs just south of the prospect. You can see it on this plan of our project up in the northeast area. This is a Google Earth image of Willamulka. You can see the cleared paddocks. It's all cereal growing country, wheat, barley, lentils in their rotation, or legumes, and which one's lentils. And then superimposed on that we have those blue contours, of gold geochemistry. And that anomaly is about 1.5 kilometres long, striking in a northeast direction. We have drill tested about just over 1 kilometre of that anomaly so far, and that's represented by the little dots that we can see on there. They're drill collars. The way they work is the purple ones are collars or holes that were drilled last year and a few more historic. The red ones are holes that we've drilled this year and have announced the results for, and the yellow ones are holes that we've drilled with the results yet to come, and they're the 50 holes that I mentioned on about the third slide. We'll just have a look at three quick sections. Here's one, just to explain the sort of the background colours. The yellow strip along the top is transported cover. That's those sand dunes and things that we could see. We then go into weathered prospective basement, and then the darker sort of browny colour is a sort of fresh rock. And then the drill holes, obviously in black, they're all inclined at 60 degrees. The yellow bars are intersections of copper and or gold. And the little boxes, they might be a little difficult to read, but it's metres, then gold grade in grams per tonne, then copper in percent. So there's 35 metres at 0.7 gold and 1.1% copper is a good hit. And then, of course, the green is our interpretation of how this joins up. And what we have is, over the part that we've got the assays back for, we have a nice coherent deposit, I guess a little bit feathery around the edges, but we can see it on that section. Here's another section to the south, still well developed. Another section to the south, a little bit less drilled. A couple of holes there, 18 metres at 2.4 grams of gold and 1% copper, and another unbottomed intersection of 18 metres at 0.3 grams of gold and 1% copper. So, pretty good grades and very, very shallow. And it's starting to, we're very excited about this because it's holding together, as I said, on section between section. That means that we can turn this thing into a resource. It's open along strike, it's open at depth. We don't know how big it'll be, but it's a very, very good start for a company just about to start its life. If we just compare Willamulka, sort of the scale of it, to Hillside, the map or the plan on the right I stole from Rex Minerals, one of the ASX releases that they've made. Those white boxes contain the original resource of 100 million tonnes that they released last July. Willamulka is about the same scale in terms of the geochemical anomaly. We know that copper goes throughout the extent of at least 1 kilometre of that anomaly. So, very quickly, just to finish up, Peninsula has a gold and copper focus with some uranium and joint ventures that I haven't had time to talk about. Moonta's the flagship project. We also have deposits that are ready to drill. There's another 3 sort of discoveries, I guess you'd say, on 3 other projects. 80% of our money is going to go into drilling, and it reflects the fact that we've actually done, our Adelaide Resources has done a lot of the early work, and by 80% I'm including the cost of assaying and whatnot with that, but it's a very high percent of the discretionary spend. 50% of the budget to Moonta at this point, and we'll have to wait and see how Willamulka unfolds to see if it deserves more. So the offer is now open. There's prospectuses available at our booth or downloading able to be downloaded from the Peninsula Resources site. At this point, we anticipate a listing on the 20th of June, and I think that's it from me. So thank you very much.
All right, thanks, Chris. Next speaker is Chris Cairns from Integra Mining.
Thank you very much, Keith, and thank you to Kerry Stevenson for putting on this event. I think it's turned out well. 10 minutes to tell you how we've gone with Integra. We're Australia's newest gold producer. We've just put a deposit into production that we discovered 3 years ago. And that's how we look to add shareholder value, through discovery and development. So we find ourselves as a low-cost producer, producing about 90,000 ounces per year. March cash cost was $468 per ounce. March was our first month of commercial production, after about a 5.5-month ramp-up. But we're looking to expand up to 140,000 ounces per year, maintaining a low-cost production profile. And without wasting any time, we've already gone into our first process facility expansion. We do have that discovery and development track record. We've discovered 2 deposits in 3 years, and we're continuing to explore and hope to make that 3 and 5. Like most gold companies, we've drifted over the majority of this year. Everything's going well with the project. We're producing gold at a $900 per ounce margin, but we just don't seem to be able to get any traction in the market, but I don't think that we're the only ones. Project's located east of Kalgoorlie, about 1,200 square kilometres under tenure. Unfortunately, if you can see that, that's Salt Creek, that's the discovery. The mill is right next to that. We call this the Aldous Project, and I'll be referring to this over the east here as the Aldous Project. Sorry, this is the Randalls Project and Aldous. So low-cost production, $900 per ounce. The mill expansion is going to be completed in August, take us over 100,000 ounces just from open pit production. We'll update our ore reserves mid-year to take our original mine life from 4 to 5 years, net of depletion. In September, we'll go underground in Cockeyed Bob to demonstrate the viability of underground mining in those high-grade BIF-hosted deposits. And we'll continue to explore with budget submissions of $23 million for next year's exploration budget. This year, we'll spend about $20 million. That level of exploration and 2 discoveries in 3 years has led to quite a significant resources growth. We've got 2.5 million ounces at the moment. In January, we added 700,000 ounces, or a 40% increase. And importantly, a maiden resource for the Majestic deposit of 260,000 ounces, a project in which we are in joint venture with Newcrest, of all people. But that's led to our discovery track record. And certainly we intend to continue that trend. So the project that's in production at the moment, the capital cost estimate was $64 million. We brought that in on time, under budget. The current rate of return on that project is over 80%, but that's not including the reserve update that we'll do mid-year. We're producing at 90,000 ounces, low cost, and expanding that up to over 100,000 ounces per year. That phase 1 ore reserve at 320, that was relatively modest. The whole idea was just to bootstrap the project into operations on a relatively small reserve, but it's very, very profitable. And then in the fullness of time with cash flow, we'll bring the rest of the assets into the production profile. That strategy is working out well, and the update will come mid-year. That's what the project looks like. Open pit with quite a large tailings dam. The tailings dam looks like a bit of a racetrack. Small process facility in the foreground with a stockpile in front of it. The process facility started off with 1 ball mill. We're adding a second one now as a regrind mill, not because there are any problems, but just to make the whole process plant more efficient and flexible. There's a number of resources within the region owned by us and other groups that if we expand the mill and add a few features, we'll be able to treat a wide variety of ore types. So that's what a 1 million ton stockpile looks like. It's 1.5 grams. We'll build this up over the next 12 months or so to about 1.8 million tons. We've got about 1 million tons coming from Maxwell's as well, and then another 2 or so million tons coming from Majestic. So we've got plenty of open pit material, and the whole idea is to blend this open pit material with emergent underground production. This is the expansion going in place, the leach tank's completed, ready for painting, and the foundations being poured for the regrind mill. But really, in terms of value adding, what we need to do is we need to demonstrate the underground potential at these BIF-hosted deposits. We don't get any value in the market for these, and hence we're going to go underground in September at Cockeyed Bob for trial mining. They're quite nuggety, very difficult from surface to drill a reserve in these deposits, but the endowment for Maxwell's, for example, is quite remarkable. If you used 700 ounces per vertical meter as a metric for break even or making a bit of money, this deposit has 2,700 ounces per vertical meter at a grade of 6.3 grams, which compares very favorably to Frog's Leg or Higginsville, for example, with average grades about 5.5 grams. These are some drill results from the base of the open pit. These will be included in a revised open pit that we release mid-year. When these quartz veins go through the BIF, they result in a chemical reaction that drops out a lot of sulfide, but also a lot of coarse gold. So we've drilled them to 400 meters last year, each of the 3 deposits. And if you take the vertical rate of advance of 40 meters per year, Maxwell's in its own right could produce 100,000 ounces per year. And there's absolutely no reason why that deposit shouldn't be able to produce in excess of 1 million ounces in its own right. We have 2 other deposits that together are probably the same size as Maxwell's. So in terms of the trial mining proposition, being able to demonstrate the underground viability of these deposits is very, very significant. Certainly when you compare that to the magnitude of our initial reserve, which was 320,000 ounces. So the prize here is well worth the risk, and we're going underground at Cockeyed Bob to prove this. Majestic new discovery, little bit unusual, hosted in granite, structurally controlled. What's not shown on this section is that most of the intervals that we drill, if you use a lower grade cutoff of about 0.2 of a gram, the intervals are typically in excess of 100 meters of continuous mineralization, within which there are geologically defined higher grade zone. This will be included in the reserve update mid-year as an open pit. We continue to drill off the north end of this deposit and also at a parallel zone on the northern end of the deposit. But it's part of a much larger project, and there's a lot more exploration to be done in that area. Eldest, we're looking at this as a second operation. There's 500,000 ounces of resources out here already, primarily in 3 deposits. But it's an 80-kilometer long greenstone belt. We control that belt, relatively unexplored. The challenge in front of us was to determine how we go from 500 square kilometers of exploration ground down to a much more focused area. We engaged with the CSIRO to develop a modeling technique whereby we could look at the fluid flows in this greenstone belt, and if we could predict where the existing deposits were, we would look in other areas where there were maximum fluid flows that were underexplored. So this was the model. It had a couple of granites to the east as buttresses, a major structure on the west called the Eldest Fault, and then the greenstones and fibrillates caught up in between with 2 known deposits at at Main Zone and French Kiss. And this is what the modeling turned up. So the big blue zone here is Main Zone. Then on the cusp of the structure is French Kiss, and then we have this big shear zone opening up in here. So that's where we've been focusing our exploration effort. In the first pass program, we drilled 1,200 holes, 60,000 meters, very wide spaced, got some great numbers, but this is an early stage exploration program and will be the focus for this year's exploration. I'll skip these peer comparisons just to say that We are amongst the lowest cost of Australian producers, and we have clear intentions to move across that graph in terms of production profile. We are also one of the most profitable producers, second only to St Barbara, but St Barbara produces 3 times as many ounces as we do. So we've developed this project. We're low cost. We've got the expansion plans in place. We can see our way to over 120 to 140,000 ounces, and we have ongoing exploration. Thank you very much.
Thanks, Chris. The next presenter is James Searle from Metallica.
Right. Firstly, I'd like to thank Symposium for this opportunity to give a presentation on Metallica Resources at this inaugural Broken Hill event. I think it's quite a remarkable feature of the Australian mining industry that you can have junior companies like Metallica Resources sharing the podium with major companies, middle-sized companies and other juniors. I think it speaks for the vibrancy and depth which we have in the Australian mining industry. Well, Metallica Resources, it's a junior company. We listed on the ASX last year in October. As a junior company, our challenges are that we have to have a focus and we have to have a strategy that will allow us to not only survive but thrive. And junior companies are faced with the issue of making progress before you run out of money. We think we've addressed this because we have projects which are focused on gold exploration in the eastern goldfields of Western Australia within about 80 k's of Kalgoorlie. What we do is we look at making discovery, but we're also looking at early production opportunities. I'm going to throw a flurry of slides on the board, but all of them are coming back to this theme as to how we run our business, which is in this sort of one leg looking for early production, and on the other making sensible decisions about how to lever value from discovery within our tenements. The usual disclaimer, I'll leave that on there for 10 seconds for the speed readers amongst you. Okay, our business model, quite simply, it's advanced stage gold, looking at making half million ounce plus discoveries within the eastern goldfields. I'll explain what that really comes down to in the next slide. The other leg's what we call mine, truck and treat. We have a number of projects that have identified mineralisation on them, and we're working those projects up to a stage where we can lever some early stage cash flow from them. Just simply we call them MTT projects. Okay, well, advanced stage exploration, that quite simply means that we have locations for our projects which are on the major shear systems in the Kalgoorlie area. These are some of the world's most gold-endowed structures, and we're conducting exploration on those. We've got situations where we've got broadly defined geology, so we're not shooting in the dark from the start. There's also previous exploration success on a lot of this ground, and you've got to bear in mind that that exploration success was largely at gold prices below $400 an ounce. And because of the history of how this ground was held, there hasn't been exploration since those times. So largely no exploration on most of our ground since about 2000. And a lot of the exploration results coming out in the 1980s, 1990s. We're also applying some newer geophysical techniques and some newer mineralisation models. And with the benefit of that, it's actually making some great strides in terms of how we interpret some of that exploration success from the low gold era. It enables us to rank mineralised targets a little bit more with a little bit more science, and that has returns in terms of focusing our expenditure. MTT projects, well, that quite simply, because we're located in the eastern goldfields, we're within 80 k's of Kal, there's transport infrastructure, there's mill processing infrastructure. We've got a number of deposits which we're working up to JORC standard resources, which are relatively soft oxide deposits, and we believe that we can find a way of getting those to mill cheaply and finding mills that will find a corner in their production to fit in our soft oxide ores. Very simple, even modest parcels of ore in this sort of economic geographic setting can have tangible value. MTT also means a quicker route through the regulatory process. Obviously, if you're only looking at a small open pit, you fall under a lot of the thresholds for the regulatory process that you have to go through. It also means a minimal capital investment if you're only looking at capitalising an open cut mine development. That means we have the potential for an early cash flow, and we can leave a value off that early cash flow in our discovery initiatives that we're moving along on our other projects. In a nutshell, we're a small company, 60 million shares on issue. We've got about $3.5 million in the bank. However, that is sufficient to sustain our scheduled exploration for the next 18 months. And that puts us in the time frame that we're looking to lever cash flow out of some of our MTT projects. Fairly tightly held company. Board of directors, we've all been around the mining industry, in the mining services and in exploration, production and development for a while, so we cover most of the bases that you need to have. Our operations in Kalgoorlie, we've got experienced people there, and believe me, operating in the Kalgoorlie area is a delight. Those of us that have experienced remote area exploration, not only in Australia but in third world countries, it's an absolute delight to be working within 80 k's of Kal. Eastern Goldfields, Western Australia. We're all around Kalgoorlie. You can see on this map here about 360 square kilometres of tenements. They're all localised on the major structures that I alluded to earlier, which are the major structures that carry the gold mineralisation, the world-class deposits and the multi-million ounce ore bodies in Western Australia around the Eastern Goldfields. It comes down to location, location, location. We're all within 80 k's of Kal. We've got proximity to that economic geography of processing and transport. We've got these two main structural corridors that host the big ore bodies. We've got the potential to make rapid discovery by levering off the exploration and the exploration models that have been developed for the Eastern Goldfields. Those two main structures there, the Zulikia Cunninulling structure, over 40 million ounces of past gold production. The Bardock one leading up from Kalgoorlie, 70 million ounces. You know, this is a world-class gold province, and there's still a lot of work to be done in the area. Okay, previous drilling largely conducted back in the low gold price era. Each one of our main projects has drilling from that era on it. We've got the Goongarrie project.